What is quantitative tightening in simple terms? Imagine a central bank as the boss of a country's money. When the economy is growing too fast and prices are rising quickly, the boss needs to slow things down. One way to do this is by pulling money out of the system. That's what quantitative tightening is all about. It's a tool used by central banks to reduce the amount of money floating around in the economy. They do this by selling off financial assets like government bonds or letting those bonds mature without reinvesting the money. When the central bank sells bonds, it takes money from the banks and financial institutions that buy them. This means there is less money available for banks to lend out to people and businesses. Less lending usually leads to higher interest rates. When interest rates go up, borrowing becomes more expensive. That makes people less likely to take out loans for homes, cars, or business investments. As borrowing slows down, overall spending in the economy decreases. This helps to control inflation, which is when prices rise too quickly. Think of it like turning down a hot water heater to prevent the water from boiling over. Quantitative tightening is the opposite of quantitative easing, where the central bank buys assets to pump money into the economy. When the economy has too much money, prices can go up too fast, causing inflation. So, after periods of quantitative easing or other policies that increase money supply, central banks might decide to do quantitative tightening to balance things out. It's a way to tighten the money supply and slow down economic activity. When central banks do this, interest rates tend to rise, which can also make the domestic currency stronger because higher interest rates attract foreign investors looking for better returns. But there is a risk. If the central bank tightens too quickly or too much, it could slow down the economy too much and cause a recession. That's why central banks have to be careful when using quantitative tightening. They need to find the right balance between controlling inflation and keeping economic growth steady. In simple terms, quantitative tightening is a way for central banks to reduce the amount of money in the economy by selling assets or letting them mature. This makes borrowing more expensive, slows down spending, and helps keep prices stable. It's a key tool in the fight against inflation and maintaining a healthy economy.